This is the Retirement Solution Podcast with financial advisor John Hicks, founder of J. Hagan Capital.
Glad to have you here with us on the Retirement Solution with financial advisor John Hicks, here to share at least a little bit of his wealth of knowledge. He spends hours and days and weeks and years of his lifetime figuring all this stuff out so that you don't have to, because you spend your hours, weeks, and days and years of your lifetime working on your job. That's why he's got his job. See, it all works out, John.
It's what they call the broad macro economy.
Ooh, right? Fancy words.
Ooh, see all that stuff that we didn't, that most people snooze to in Econ 101?
Me.
It actually is somewhat useful.
You liked it.
I mean, you had me in a biology or I kind of liked chemistry. I like the idea of blowing stuff up a little bit. Biology, as soon as I went in there and like we're dissecting, we didn't dissect frogs.
Yeah.
We had baby pigs.
We had baby pigs too.
That
was
and
a
we
little
had
rough.
sharks.
Sharks.
Baby sharks.
Huh. Interesting.
Yeah. And so I don't have a phobia.
Okay.
I do not like sharks.
Okay.
The smell of the formaldehyde or whatever that embalming fluid is, it was so gross. And so like, I just never got past that in high school. So I never wanted to go further. Yeah. And all my friends were like, John, I'm going to go into medicine. I'm like, you are deranged. Now, I'm so glad they did it. It was great because they're all very successful, accomplished physicians. Yeah. But I'm just like, dude, how'd you get past the smell? Oh,
Same way you got past economics 101 without falling asleep in class. See,
I was
we
good
all
at the
have
abacus.
a purpose.
I was good at the abacus.
We all have a role here to play. And so you're going to play yours. Speaking of things you don't like, speaking of things you like to talk about how much you don't like, let's talk taxes.
No, boo.
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 Hiss.
That's not what weekends are for, boo.
Talk about tax loss harvesting?
Okay, all right. It is the harvest season.
Come on back.
So, okay, there's nothing wrong with that.
End of the year is just weeks away now. It may mean it's time for you to do some tax chores of your own. One strategy that investors often use is what we were just mentioning, the idea of tax loss harvesting.
Yes.
Step one, can you explain what that is? Just the basic, let's do our own Econ 101, Financial 101.
Yeah.
What is tax loss harvesting?
So the easiest way to think about it is turning lemons into lemonade, right? Mm-hmm. So some of us have taxable investments in our brokerage account or whatever it is, and we lost money. It stinks, but it happens sometimes, right? Maybe we owned a good company that we really don't want to sell in the long run,
right?
But maybe it's down 25 or 30%. Well, how can you potentially get a benefit out of that? Well, by tax lost harvesting. So this becomes a very easy thing that even no matter how much money we have, if we have a taxable account and we have something in it, whether we want to sell it in general, or if we just want to take a tax loss so that we can offset that against gains, we can do that. And it involves, I'm going to use an example that I've used a lot over the years. So a lot of people I know worked at General Electric, GE. And GE stock for a very long time was really good until it wasn't. And then it just absolutely hit the skids, and it's not honestly been the same. So, but a lot of people out there have General Electric stock that is what we call underwater. They may have paid $1,000 for it. It may only be worth about $500 right now. Okay. So here's a way to turn lemons into lemonade. Okay. So instead of holding on to that GE stock forever and hoping it comes back, an example would be to sell that GE stock. And what do we get to do? We basically get a tax write-off for that $500 that we no longer have, because we paid $1,000. It's only worth $500. We sell the stock. We only get $500. That's $500 we can potentially use against our ordinary income. Okay. Now, there's two things we can do at that point in time. We can wait for 30 days or longer to buy that General Electric stock back so that we can keep that tax deduction. Okay. But here's what I'd really rather someone do. Instead of putting it back in one individual company that may or may not get that money back, get a good, high-quality, exchange-traded fund like Vanguard or Fidelity or Schwab that's growth-oriented, or you may not even want growth, value, or dividend-oriented. Some very good like Vanguard dividend funds or Fidelity or Schwab income funds or dividend funds you can invest in. Hopefully it grows over time, but number two, it may give you a very attractive dividend. And by doing that, you got a tax loss by selling the GE. You get a $500 offset against your income. But number two, you're probably diversifying to a more attractive asset that, frankly, it may not even just be in your name your whole life.
Right.
If you get a good like Schwab growth fund or Fidelity growth fund or Vanguard growth fund that's super cheap, that may be what I call a generational asset. because they're always going to change the holdings in there to replicate what's really good in the economy right then, right?
Right.
Whether they have the best dividends or they have the best growth opportunity, they could potentially hold that for 500 years. Maybe not 500 years, but they could own it for many generations. Those are what I like to call legacy assets.
Okay.
So whenever we're doing tax analysis for a client, if we're ever going to pare back a position by doing tax loss harvesting, we typically don't want to add back an individual stock like GE or Microsoft or even NVIDIA. No matter how good it's been, I would much rather own a super, super cheap exchange traded fund that I can own forever. And hopefully, with the diversification and the low cost of ownership, it does better than that individual stock in the first place. Okay. That's one very smart thing to do for any of us, no matter how much money we have.
All of that said, the idea of tax loss harvesting, as great as you did, just baselining it, I still feel like it can be a bit of a tricky situation. So thinking about somebody who's a DIYer, what is the complexity there? I
mean, there's 78 plus thousand pages of tax code. I mean, that's no joke. I mean, there just really is over 78,000 pages. So the thing of it is that a lot of people get confused and they think I can do it in any account. You can't. You can't do it in a Roth. You can't do it in a tax deferred account.
Okay.
It has to be a taxable account. Now, are there ways to shift your assets from tax deferred accounts into taxable accounts and take advantage of tax loss harvesting? Absolutely.
Okay.
We do that every day in my office.
Okay.
But there are so many different complexities. But see, listen, even though I passed the CPA exam, I'm still not a practicing CPA because I did not spend 2 years of mandatory accounting work at a major CPA firm. So I can't call myself one. But that's why we have CPAs on our staff and tax attorneys, because these guys, it's all they do. Like, I don't just spend my time blathering on radio every day or on television or whatever. Really, most of the core of what we're doing is designing processes, basically being architects of how can this client that has these assets and this real estate and these goals, how can we get them where they want? But I typically, instead of me going out there being the contractor and putting on the roof myself and doing all the plumbing myself and building the pool myself, I need specialists that do that, right?
Right.
Wouldn't you think that a roofer who has done this for 30 years is better at putting on a roof than me? I do. Don't I think that plumbers who've been doing this for 25, you guys are out there. I talk to you all the time. Electricians. I want these skilled people doing those jobs. That's why we have CPAs and tax attorneys on our side. Because there's one thing that CPAs are great at. They understand the rules and the tax codes. But tax attorneys, I find, are often very necessary. How to avoid that tax, not just today, but over the next 15 or 20 years as laws change. They always do. How do we make sure the next generation doesn't pay taxes, or our surviving spouse is not in a worse tax bracket? Not all my CPAs can do it the same way that a tax attorney can, because they're typically looking at the laws. What is allowed? Not just today's tax code, but futures. And, you know, Heather, perfect case example, there was a gentleman we talked to a few months ago, but he recently became a client. He was looking at a $2 million income. Okay. $2 million income.
Okay.
And the year before, he'd paid nearly a full $1 million in taxes. Jeez. He came to us, had the same $2 million income. We just got done because he filed a late extension. He's only going to pay $177,000 in taxation on the same $2 million of income where he paid nearly a full $1 million the year prior. Everything that we did was not only legal, kosher, and honest. It was stuff that his CPA had looked at, just wasn't sure how to do it. And our CPAs were like, interesting. They were aware of it, but they didn't apply it. They didn't implement it. Okay. They were aware, but they didn't know how to do it. Did they understand that you need that real estate in its own LLC? Did they realize that you can deduct these things legally as long as you have your documentation? Don't make it up. You need real documentation. But if you have that, which the gentleman had, there was no reason those things couldn't be deductions. We also parlayed a lot of his money because he had all of this money, Heather, in bank accounts because they were paying him 5% for most of the year. Well, he was paying ordinary income rates on the bank interest, which is the most offensive part of the tax code. He was basically giving away 50% of that bank interest. So that 5% he was earning, he was really getting like 2.5% of that. So we fixed that. So now he's getting more than 5% with the same amount of safety. Here's the craziest thing. He pays no taxes on an annual basis. We have deferred and in some cases eliminated taxes on that income. So there's a perfect case scenario of a gentleman who, frankly, he's doing great. When you make $2 million a year of income, you're probably doing okay.
Pretty good.
But the year previous, he basically only got to keep half of what he made. Half. And he didn't get a divorce. right? So that is not a good statistic to be in. That's not what you want to have is, man, I only got half last year and I didn't even get a divorce. That's a ripoff. So this year, he's only going to pay $177,000 of federal taxes on the same $2 million of income because of proper tax planning. Now, did we start there? No. You have to have the first two things in your first. How much protection do you need and how much income do you need? Those two things lead to tax design. It was the third thing we did, which is why it took us a little bit of time to come up with that. We wanted to make sure that he wasn't producing too much income that he didn't need. That's when we found all those bank accounts. I was like, dude, what are you doing? How come you're not spending all this money? Then why are you generating it? Why don't we defer and kick this can down the road until later, and we'll come up with other ways to do asset shifting and get those dollars into tax deferred or completely tax-free in your lifetime situations. But there's a perfect case scenario. It starts maybe with just a little tax loss harvesting, but in the end, it becomes a full-blown tax strategy to save the most money you can for hopefully not just your life, but for your surviving spouse and your kids' lives. That is the way to plan for retirement.
What tax opportunities do you have right in front of you that you are not aware of and not implementing? This is what John and his team dig around and look to find with and for you, all an effort to help you do exactly what you should be doing, keeping as much of your hard-earned money as possible within the letter of the law. This is what we are here to help you figure out. Let's start this conversation. RetirementSolutionShow.com is where to do that. You can also click on the links we've got posted in the show notes to go to our website, which is, again, RetirementSolutionShow.com.
Thanks for listening to the Retirement Solution Podcast with John Hicks. Begin the conversation about your savings plan with John and the team at J. Hagan Capital by visiting RetirementSolutionRadio.com. Be sure to listen to John's radio show, The Retirement Solution, Saturdays at 8 a.m. and Sundays at 9 a.m. on News Radio 840 WHAS.
J. Hagan Capital Incorporated is not licensed in all 50 states. To find out if J. Hagan Capital Incorporated is licensed in your state, please call 502-690-5635. J. Hagan Capital Incorporated is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. By contacting us, you may be provided with information about insurance and annuity products offered through J. Hagan Capital, LLC, NPN number 1882794.